Good evening, everybody. This is Sherry Locke, and welcome to Financial Freedom Classroom. We accelerate your results. And tonight, I'm going to tell you a little bit about us. We are John and Sherry Locke, owners of Locke and Your Success LLC, stock options trading, coaching, and education. We also have managed many different businesses in various industries. We are active real estate investors, and we provide loans and guidance to small businesses and love to do that. Tonight I am thrilled to have my husband speaking, John, who is just brilliant in stock options trading and really in business in general. So I'm going to have John take it away.
Hey, good evening, everybody. Thank you for joining me. Before we get going, we have to do the regular options and disclaimer issues here. We're letting you know that we are not licensed financial advisors. We're not accountants. We're not lawyers. And we do not know your specific situation. So any information we give is our opinion. And if you want to take action on it, you should always consult the proper professional in the field that is relevant to whatever questions that you have or whatever you're going to do. Also, since we are talking about trading tonight, we also need to let you know that the presentation for trading is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, the risk in trading is substantial in both trading the equities and the options we're going to be talking about, and that we are going to be using computer simulated trades, which are believed to be as accurately represented as possible. However, our live results may vary. So when we talk about financial freedom and Financial Freedom Classroom, we always talk about our five phases to financial freedom, and in phase number 5 is put your money to work. And we're going to talk about putting your money to work in what we call super simple spread trades. Now, before we get going here, this is kind of advanced for this format. In other words, if you don't have some sort of an options background, you're not going to understand what we're talking about. That does not mean that you should not listen. You're just not going to understand the trading example that we're going to give. But what you will get out of it is you'll get the difference between what trading in this style might do versus trading maybe a straight mutual fund or just plain investing money in a stock or maybe an index or something like that. So definitely worth the look, but just be aware that it's probably going to be advanced if you're not familiar with what options spreads are. So when we talk about putting money to work, we're talking about investing, and the question becomes, how can I put my money to work so that it can appreciate passively or with minimal effort? Now, one of the things we got to remember is there's really no type of investing that's completely passive. We have the 3 primary things that people usually invest in is real estate. And real estate's a great place to put your money. We put our money there. And in general, it's passive. We have increasing values on real estate. We have rents. We have positive cash flows. But there is effort. We do have to do something in order to make that money. It's just that the amount of work we put out relative to what we get back is very small. And you can get that same type of thing if you invest in a business where you're not the operator. Obviously, if you are the operator, then that's a ton of work. But you can invest in businesses where you're not the operator and you're relatively kind of a silent partner and make money that way. And another way we can do it is we can invest in the stock market. Now, when we talk about investing in the stock market, most people or a majority of the people look at trading or going with mutual funds. If you listen to most financial experts, they recommend buying index-based mutual funds with 2 assumptions, is that an index generally rises. So over time, historically, any long period of time, the market generally rises. And therefore, depending on how you calculate averages, if you're looking at the S&P 500, you're looking at an average of somewhere, if you're looking at raw numbers, somewhere between 7 and 12% average a year. Again, depending on how that's calculated. Another reason they go into indexes with your mutual funds and so forth is simply because your money's spread out over many, many assets, and therefore, at least in theory, you are more diversified and you're safer than you were if you were in individual stocks. And I tend to agree with that in general standpoint. So we have a downside when we invest in mutual funds. If you're doing an index-based mutual fund, it's very rare that you're going to beat the index itself, especially after fees. Usually the traders within the index use the S&P 500 as a benchmark, and if they beat that, they are thrilled. And even if they do beat it, a lot of times you don't beat it because you've paid fees, and it's generally hard to make up those fees. Another thing that happens is you only make money if things go up. You lose money if things go down. And if things stay the same because you're actually paying fees, you also lose money. The other thing is that you have limited control of when you're in and out of the market, which can be a good thing, can be a bad thing. In general, most experts will tell you to stay in the market and ride out the dips, continue to invest, and just wait for the market to come back. And in general, I actually tend to agree with that, because what I see is people dumping out of the market when the market comes down and then being afraid to get back in, and by the time they do, they've missed all the gains, and they take a return that's average 7 to 12% a year and they turn that into a negative number or something that's much less because they missed the biggest updates in the market. So, depending on how you want to trade, those are the pitfalls with investing in mutual funds. We do have options where we can do better than that, and we can still kind of go on the same concepts that, hey, the markets generally go up most of the time, and we can make money off of that, but we can also add to that with stopping ourselves out of the market at certain times and then getting back into the market at certain times, which sounds kind of like timing the market, but it's really not, because we're not using technical analysis in order to do that. We're just usually using simple time frames to do that. So if you have a basic options education and if you have a discount broker and you're willing to put in at least a minimal time commitment, you can have a whole lot better control over your financial future. So it allows you to direct your money simply with a minimal time commitment without guessing the market direction. And we do this with what we call high probability positive theta trades that make money with the passage of time as well as directional moves. If you're looking at the typical buy a fund method, right, this is just what we call an analyze graph and a piece of software called Option View. And typically if you're buying a fund, you get something that looks like this. We have the price of, in this case, this is the SPY, SPY, and this is the value of your position. Essentially, if the market goes up, you make money. The market comes down, you lose money. It's a direct one-to-one thing. And of course, if you sit, you lose money because you're paying fees if it's a broker, if you're paying somebody to do this for you. If you have a discount broker and you simply buy the SPY, you'll probably outperform your mutual fund, right? So that's certainly one option that you have if you simply buy it and stay in it and continue to invest the same way and you ride out the dips. Typically, you'll do better. We do have an option, though. We can use something that's in a program that I have. It's called the super simple spread trades. Now, these are super simple for people who know complex options, but it's not going to be very simple for somebody who doesn't know what an option is, right? So this is the part where you may or may not understand, but we will take this and we'll run with it. So this is a simple bull vertical spread. When you have a bull vertical spread, things go something like this. If the market goes up, you make money. You might not make as much money if the market goes up a lot as you would if you were just buying an index, but you will make money if the market goes up. You will make money if the market sits, because over time the profit just gradually gains and goes towards the red line here. And even if the market comes down, sometimes you can make some money. Now, this particular positioning is a trade that I call the bull, which we went over, I don't know, several months ago in Financial Freedom Classroom. And if you want the exact rules to that particular trade, you can go back to our archives and look for that. And the rules for this trade will be here. But that's not what we're doing today. We're doing what we call a bull versus bear trade. And again, that's one of the trades that's within the super simple spread trade method. So most of the time when you do the bull versus bear trade, you're going to be in what we call a bull. because most of the time the markets tend to either be stable or go up, in which case a bull trade makes money. The only time it doesn't make money or possibly loses is if the market comes down considerably, in which case in this particular trade you would just lose. But if you're doing a bull versus bear trade, we look for times when the market's been up excessively. So if we're in a bull versus bear trade, when the market goes up substantially, and the substantial point, what I would call, we trade this bull versus bear trade on the Russell 2000. If the Russell 2000 goes up 80 points, that's a pretty substantial move for that. 80 points in 60 days, that's a fairly substantial move for that. And most of the time, if that happens, it's not likely to go a lot higher. And since it's not likely to go a whole lot higher, what we do is we add a bear trade on top of our bull trade. Now, we want to keep the capital levels the same. We don't want to go more than that. So we'll reduce the size of the bull trade and add a bear trade on top of it. And this is going to react something like a condor. So if you know what option spreads are, and you know what a condor is, it's going to react something like a condor, where if the market moves up excessively, you could lose, but that's not likely because we're entering a position where the market's already been up a lot. It's possible, but not likely. We are also possibly going to lose if the market comes down. However, this is more resilient in both directions than a condor is. Plus, it's capable of making a lot more money in a condor if things go right. So this is a good, viable trade rather than something like that. Yet the general concept behind them tends to be the same. So if the market continues higher with this, if you know what the bearish butterfly is, the bear trade is just a simple variation of a bearish butterfly where we come in and we add more butterflies as the price goes up to raise and widen the tent area. And seeing as how the market's already overextended considerably, chances are we're not going to outrun that position and we're probably going to do fairly well. So if the market gets to the point where it's up so much that it's just crazy unlikely to go higher, then we just completely forget about being in a bull trade and we just go straight into the bear trade. And then we do that at times when the market's up more than like 110%, maybe 120 points. You can get into something like this. And again, it's very effective as well. So in short terms, without getting too much into detail because we don't have a lot of time, that's what the bull versus bear trade is. So I'm just going to go over an example. And excuse me, I purposely picked this example because it was a time when the market was down a lot. And we're going to have a really, really hard up move. So that being the case, if you were in a mutual fund, you would have actually done pretty well. It's going to be, we're actually going to go over a 7-month period. And if you were in a mutual fund, you would have had, in other words, we're going to pretend that since we're trading the Russell, we're going to pretend we bought 100 shares of IWM on this date, 10/15/2014. Not 100 shares, but $100,000 worth of shares in the IWM on 10/15/14, and we ran all the way to today. If that were the case, you would have had about a 7-month period, and you would have been up about 15%, which is huge, right? That's huge for 7 months in mutual funds. And if you look at the chart, let me bring up the Thinkorswim chart. If you look at the Thinkorswim chart, this time period, let me go, I probably should have had this ready for you guys. Right, this is basically from here to today, right? If you come off this bottom and you bought pretty much at the bottom, right, you're looking at a gain of in the 15% range, which is very, very big. Now, let's compare that to doing our super simple spread trade strategy. So, and generally, if you're doing a bull versus bear, let me pick this up, and we were to go back to October 15th, which happens to be the date when a bull versus bear starts, which would be a 65-day expiration trade. If we were to look at the charts, right, the market has been down substantially, and essentially it's time to enter from a date standpoint. Because the market's been down, we would just do a bull trade, right? It's nice and simple. You'd come in here if you were going to do a $100,000 bull trade. Let me get this here. It would be 36 contracts at 10 delta, and it would actually be 30 points wide, which it is. We're just missing a strike here in option view. So we would have a position that essentially looks like this. We'd have about 100,000 invested. In this case, it's just under 100,000. And in this case, we'd have about an 8% profit number if we actually ended up getting all the way to our expiration graph, which would give us a maximum loss. In other words, we would leave this trade if the market came all the way down, maybe to around the 1010 area. We'd hit a stop out point and we'd have to exit. So essentially, as long as the market goes up, there's really nothing to do here. So this is our start point. So from here, I'm just going to move ahead to 1028, which actually isn't that many days, but the market is so aggressive that we've been up substantially. So I'll show you the chart here. Right, so if I come into the price chart, you can see we were down here somewhere and now we're all the way up here, which is a really explosive move to the upside. Now if we take a look at this, we can see that we have actually been up from about 1050 to over 1130, which is more than 80 points. So if we're more than 80 points up, then I can enter a bear trade. So what I'm going to do is I'm going to come in here and I'm going to do a bear trade. Now I need to keep my capital level under $100,000. So what I'm going to do is I'm going to exit half of my bull trade, and then I'm going to enter a bear trade, so appropriately sized. So generally we're looking at a 6-to-1 ratio here. So I'm going to do a 6 lot. In this particular case, I'm going to drop from 36 contracts to 18. I'm going to do a 6 lot. Start a 6 lot bearish butterfly about 20 to 30 points under the money. And it's going to give me an analyzed graph that looks like this. So now, if the market backs off, then I'm not losing money anymore. If the market decides to sit because it's been up so much, I also have a good chance to make money. If the market continues up, I'm now negative delta. I'm probably going to lose if it's aggressive. Maybe take off some of my profits. But what is going to happen is which is going to happen, by the way, I'm going to scale in to a bearish butterfly. I'm going to add another third up higher and then another third up higher. In case you're wondering what this does to your capital, right, it actually reduces it to about in half. Now, it may go up back again close to the 100,000 if we get scaled in 3/3, but in generally initially it's going to drop your capital level down substantially. So you're risking less total in the market. So from here, and I'm going to go over this relatively quick. This is going to be, going forward, it's going to be much, much more moves or many more adjustments than normal in this type of a trading system. Usually there's very, very few adjustments. There's going to be a lot more than normal because this market move is just so aggressive. So, just be aware that it's unusual. But even so, we're going to go over 7 months and maybe the next 10 minutes, right? So we're going to be moving along here. So if I go to the 28th, and if I go to the 31st, essentially what's going to happen is if I have a bearish butterfly, if I enter at 1220s, I have an add point at 1260, I have an add point at 1160, I have an add point at 1180, and I have another add point at 1190, where I add my, I have an add point at 11, let me say that again, because I was wrong. I am at 1120, I have an add point at 1160, I have an add point at 1180, I have a roll point at 1190, where I roll my butterflies forward if the market should go that far. It's very, very unusual if you're entering at 80 points up plus. It's very, very unusual to get scaled in 3/3, and it's extremely unusual to have to roll. But this is going to happen here because, like I said, this is just a crazy, crazy up move. So if I go to the 31st, I'll just show you what happens here. So the market was up over our add point of 1160. So we go ahead and we add in our second third. And you can see we're getting more aggressive. Now we're actually could take a loss if it goes too far to the upside. But theoretically, by now, the market's very overextended. It's unlikely to continue to go higher. That doesn't mean it won't, as you will see. So let me go to the 12th of November. What we have here is the market actually continued to rise, and it's past our 1180 add point. We're also 65 days to expiration in January. Now, if you were trading a bull trade by itself, if you were 65 days to expiration in January, what you do is you close the trade for December, and we reopen it up in January at 10 delta. And we're just going to do the same thing. Because we're still going to have the bear trade on, we're only going to do half the number of contracts. We're going to stay with the 18 contracts. So we're going to go from this to this. This gives us a little bit more power now to hedge against the losses should the market continue to go up. And because I'm 3/3 scaled into a butterfly, I'm also very resilient to the downside. So if I take a look at this now, this is what my new position looks like right here. Of course, if the market backs down and kind of chills out for us, we could end up making a very, very good return, for the time period we're at. But that doesn't really happen here. So what happens is, let's see, we are on the 12th. I want to go to the, I was going to show you the 19th because the market does back off very temporarily. Right, if we go to the 19th, the market does back down a little bit, gets us up to the $10,000 level here for a return, which is, again, would be good for the time period that we're dealing with. But alas, the market goes back up again. It was just one of those temporary reversal blips that we had in the crazy upturning market we had earlier in the year. So I'm just going to move ahead to the 26th. And what happens on the 26th is we actually hit our 1190 roll point. So we're going to take off this 1120 butterfly. We're going to bring it up to 1180. And I'm just going to go to the new position, unless, of course, somebody says they need to see the old position. Right, so what we did is we exceeded our 1190 add point, or actually we just barely tagged it. And we just simply rolled from our 1120 to our 1180, and we went into a position like this. Now, again, this is a situation where we would have been better off just owning the IWM because the market's just been so irrationally high. However, the market's not usually like that. The market's usually a lot flatter, and you'll see how fast this recovers and how much faster it gains as soon as the market actually starts evening out a little bit. But this is the position we happen to be in at this point. We go to the 26th. And on the 26th, the market continues to rise. Oh, actually, we did this. The 26th, the market rose. We did the leap, right? So let's just go to the Friday, which is the 28th. And now we are 21 days to expiration. Because we're 21 days to expiration, one of the things with the bear trade is we never take it into expiration. This is meant to be a very conservative trade when you do the bull versus bear. In other words, we're very concerned about taking excessive losses, and because of that, we stay out of expiration. The closest we go with the bull is when the next month is 65 days to expiration. The closest we go with the bear is when the bear is 21 days to expiration. So what we're going to do is we're just going to close out the bear trade, and we have an if-then rule. If the market's 25 points or more above our lower short strikes, then we go into January and we enter another bear trade there. If the market's below 25 points or below 20 points, if you're 20 to 25, it's kind of a little subjective. But if you end up below 20 points over, then we're just going to close out. We'll double up this for size, and we'll continue trading. In this case, we are over 20 points, over 25 points. So clearly we stay in the bull trade. We just flip this over into here. and our new position becomes this. Okay, so moving forward here, and things are going to slow down a little bit relatively quickly once the market flattens out. We'll really start covering time. But so we're at 1128. Essentially, we do nothing till 1217. And on 1217, what happens is this, right? You got to remember this is what, 20-something days. This is going to be 65 days to expiration. Therefore, we will close this trade, and we will just simply move it into the following month. So if I shoot up to December 17th, you'll see that we closed out our bull trade in January, and we added our bull trade down here in February. And this is our new position here. Looks like that. If I go to the next period of time, which is going to be, let's see, 1219, I have to add the second third to the bear trade because the market continues to go up. So I go to 1219, now I'm 2/3 scaled into the bear trade because I hit my add point, which is going to be 1190. And that brings us a position that looks like so. If we continue to go till the 26th, I am 21 days to expiration with the bear trade. So let's go to the 26th. All right, the market continues to rise here, kind of irrationally at this point. If you take a look at the price charts, right, we came up here, we ran sideways a little bit, we kind of got hammered with a down move, and now we're way up here again. Basically, if we didn't do anything, it would probably be pretty much time to actually add our last third in. But because we're 21 days to expiration, we're simply going to exit this. We're going to push this over and start over again in February. So let's just go into February. And again, this is a running profit loss for the whole campaign. So here is where we are now with our new position. And if I back this out, you can see how wide this position is, right? This is a $12 interval, and I have to go to a 20 to really get an accurate picture of what's going on here. So this is what our position looks like here. If we move forward to, I think things are going to start picking up a little bit, a 14th, then on the 14th of January, this becomes 65 days to expiration. I'm going to close out these verticals, and I'm just going to go into our March verticals. So let's do that. Let's go to the 14th. All right, so now we're covering basically whole months at a time without, or at least 3 weeks without having to do anything. So here is our position. I closed out the verticals here. I rolled them over to here. This is what our new position looks like here. So everything is going fairly fine. If we push to, John, so I just had a question here. Would one never do a bear trade in a bearish market? According to this system, no. According to, if you're an advanced trader, you might do a bear trade in a bearish market if the market was overextended within that bearish market. But according to, well, actually, yeah, you might get into a bear trade in a bearish market if you get a harsh reversal. So in other words, the market drops 200 or 300 points, for example, or maybe 100 points, and then bounces 100 points. Then you would be allowed to get into a bear trade. It would be a high-risk bear trade because if the market reverses and keeps going up, then if it's had a 100-plus point drop, it's more likely to outrun you to the upside. But in general, if you're in a slow, bearish, down-moving market, you would generally be pushed out of a bear trade and continue to stay in a bull trade, usually doing okay, but probably not doing well, doing better than you would in mutual funds, because in mutual funds you'd just be constantly losing money. In a straight bear trade, you might be winning money, you might be losing a little bit, you might be winning a little bit. Basically, if it's a hard trend down, a bull trade has a mechanism based off of your VIX when to stay out. And generally, if you're having a hard trending down market, In other words, we don't have downtrending markets anymore. If you look at the last 20 years, we have markets that fall out of bed. VIX goes out of sight, they bottom out, and then they blast up, right? So in those circumstances, you'd be doing the bull trade, but as soon as the market fell out of bed and the VIX popped up over a predefined number that we have, and I'm kind of averting that number because I don't remember offhand what I put in the program, but if it falls out of bed, you're simply going to not do anything. You just get out of the market and you wait till the volatility drops again, and then you go back into a bull trade. But or maybe a bull versus bear, depending on how high up the market is. But that's typically how that works. So here we are in this position here. Yeah, okay, that looked like it was off. We look in this position here, and I don't remember where we were. Oh yeah, we just started this this bull trade over here. And let's see, if we're on January 14th, our next date is January 30th, where the bear is 21 days to expiration. I know we're going kind of fast, but we're actually over time already. So, right now the bear trade is 21 days to expiration. We're currently below the short strikes in the bear trade. Therefore, what we're going to do is we're just going to close this trade out, and we're going to double up size on the bull trade and be right back into our normal full-sized bull trade. And now we're in a position that looks like this. Okay, so that is that position. From here, let's see, January 30th, I go to 211. I have to go on 211. All I'm doing is I'm closing these out and I'm switching into April. So let's go to 211. Right, these ones get closed. April gets opened full size because we are not up enough to actually put us into a bull versus bear trade at this point. From here we go to 224. And on 224, the market's overextended again. We're clearly, if we take a look here, we are 80 points up now in the last 60 days, more than 80 points up in the last 60 days. So what we're going to do here is we're going to close out half of these bull verticals. We're going to go into the bull versus bear trade again. And this is what our position looks like now. Again, with the assumption that the market's probably going to back down and we're probably going to be okay. So let's go to 311. Again, no adjustments till 311. And on 311, the only thing that happens is we are 65 days to expiration. So we closed this bull trade and we went over to here. Right, so now we're getting a more sideways market when, or at least a drop in the market when you're not making any money anymore in the other system. So, and if you just bought the index. So here is our new position here. From here we go to 318 where we add a second third. Right, and I just want to push it to the end, and then we'll just take some questions. Just, I'll show you the, you'll see what kind of comparison we have for numbers. But here we added our second third. Then we go to, and I'll show you what that looks like. It's going to look like this. Then we are going to head up to 327 when we are 21 days to expiration, and we'll remove the bear trade. Right, we removed the bear trade in April, and at the time we were more than 20 points or 25 points over our short strikes, the lower short strikes, so we went in and we continued with the bear trade into May, and that gives us a position that looks like this. And then from here we went to 330 where the market had risen to the point where we add the second third of the bear trade in, which is going to give us a graph that looks like this. And from there we go to 415. where it's time to move the bull trade because this is going to be 65 days to expiration, right? You can see we're going through like half months or whole months at a time. We ended up pulling this off. We also ended up adding the last third into our bear trade because the market's up so high. And we ended up in a position that looks like this. And then on the 24th, let's go before we do anything here. Our bear trade is 21 days to expiration. We are more than 25 points over our short strikes. We close this out. We bring our bear trade into June. Okay, there is our new position here. And then 424, we do not need to do anything until 513. Now you got to remember there are stop out points to the bull bear trade. We just happen to not hit any of them at this time. So, but anyway, we're going here. We're 25. We are actually 65 days expiration in July. So it's time to bring the bull trade over to the others into July. And this is what we look like on this particular position here. And then we go to the 29th when the bear is 21 days to expiration. Again, there were no stop out points here, hit or no add points. So we're just going from a time basis. We were 21 days to expiration. Let me back up a half an hour. Right, this time I'm not 25 points over my short strikes. So in this case, typically I'm just going to exit the bear trade and I'm going to double up size on my bull trade. So I'm going to go to here. Gives me a graph that looks like this. And that is essentially it until today, right, June 4th, which puts us in about a $42,000 profit for that, hypothetically back-traded. So if you're looking at this, if you're looking at the fact you're risking about $100,000, you would have approximately a 42% return on a campaign like that. It's a little bit more work than buying and sitting, but it's well worth it when you compare that. You know, if you did the same thing, if you had bought IWM here, down here, and you held it till here, you'd be looking at about 15% or so of a return on the money. And this is an incredibly large or aggressive up move. If you have a market that's more flat or a little bit more normal, then you can certainly drastically outperform what the market does in with just a bull versus bear type of trade. So that's basically how a bull versus bear works, and this is how it compared against a just buying stock or possibly buying a mutual fund. If within a similar time period, of course, different time periods are different. The good part about this is if you get an extended down move in the market, usually the volatility levels are going to pull you out of this trade and put you on the sidelines until they drop down again. So if you get a 2008 situation, you're going to tend to do a lot better than you would if you were to hold it until we until we hit the bottom in 2009. Of course, you would have missed the bottom of 2009, and you wouldn't have got in it for I think until like April or something when volatility levels dropped. So you would have missed the very bottom, but you would have also missed a lot of the losses. Overall, trading it through that whole time period is fine. So it's a very interesting trade. It's very simplistic. There's not, you're not paying attention to delta numbers. You're not paying attention to a lot of other things. It's just price points, checking it once a day. Very nice type of system. So, and this trade is within the bull versus is within the super simple spreads trading system if you're interested in something like that. So if anybody has any questions, I mean, I'd be happy to answer them. And I know this was really fast, and if you are not familiar with option spreads, you have no idea what the heck I'm talking about. But yeah, we can certainly take that if you would like. All right, well, it looks like we are pretty much all set from the question standpoint. Let me get my slideshow back up here from current slide. And I think, Sherry, you want to take over, hon?
Okay, so sure. Thank you very much. That was in depth. So if you want to join our free weekly webinar, a monthly webinar, sorry, there's a link for that, and you can visit our blog. We post each weekday. And if you would be interested in any coaching, you can email me. And if you have any questions, we'd always be happy to answer those, so you can send those right along as well. And next month, boy, we have an interesting topic, health insurance. Oh my goodness, that John and I have been looking into that, and boy is that confusing. So I hope that you'll join us next month with Alice Young. She's from the Page Insurance Agency, and she's going to help us understand more clearly the way healthcare is set up now. It is definitely very, very tricky, and you have to really, really pay attention. One of the things, just quickly, John, you can emphasize this if you want, but John was surprised when we were looking at health plans. They all don't cover out of state. So if, for instance, we live in New Hampshire, which is pretty rural, and the hospitals aren't always as up to date as a place like Boston, Massachusetts. And a lot of people that we know many times have to go down there for surgical procedures because there are more there's obviously bigger facilities and so forth. So we found out that all but one, it wouldn't be subject to the healthcare insurance that we would choose. So that's kind of scary if you're expecting that, right, John?
Yeah, it is. What it basically means is that if you have to go out of state to go to a specialist, which we know is going to be a ton of money, then not only do they not cover it, but they don't count it towards your deductible, which is kind of crazy, right? So, I mean, what do you have insurance for? Which means if you need a specialist, you can't do that. So stuff like that, you really, and the thing is, you can't change your provider either, except for in November. So if you run into that situation, you're kind of screwed.
Yeah, so I mean, just join us because it is a very complicated, and you think you understand it. I mean, I've read it for probably a couple weeks now, and what I thought it said, or what I thought it meant, it doesn't mean. So join us, and please bring your questions and take a look at it, because it could really help you. So I hope that is helpful. So thank you all for joining us this evening, and we will be with you again next month.
Yes, we will.
Everybody.
Thank you. And I do have just a comment here. It says, can I put all the links in the slide in the chat? So I am going to assume that we're talking about these links here. So let me do that. And I believe they are all there, so let me send that to everybody in case you are interested. And I'll give you a minute to copy that before we close the meeting. And again, I would like to thank everybody for joining us. I really appreciate it. Hopefully we didn't confuse you too much if you're not that familiar with trading. And if you are familiar with trading, hopefully we didn't go too fast. But just a lot of information to jam into a half an hour or so. But you know, I want to give you as much as I can in as short a time as possible. So thank you very much, and we shall talk to you next month.